It's Saturday morning at 10 a.m., so you know what that means. It's time for What's Up Ocala? With tens of thousands of viewers every month on our YouTube channel and millions so far on TikTok, we are joined by our host, local owner and broker of Great Expectations Realty, Andrea Praber.
Awesome. All right. Good morning and welcome to What's Up Ocala. I'm your host, Andrea Praber, and today I have a very, very special guest. Tom, why don't you tell everyone who you are and more importantly, what you do?
Absolutely. Thanks for having me on. My name's Tom Brodie. I'm a national account executive with Cost Segregation Services. What we do is we help commercial building owners really maximize their investment by showing them how there's tax incentives out there for commercial buildings that they've never heard about. And so we work with everyone's CPA. So we're not in competition with your CPA. We're just going to show them how to do depreciation a little differently. We do all the calculations and we'll support it 100%. We've had over 65,000 studies done, and not one of them has been returned by the IRS. So we have a great track record on this. And it's not as scary as people think. They just, when you say anything about the IRS, people get nervous. But we know exactly what they're looking for, and we're going to give them exactly the information they need.
Oh, that's fantastic. Okay, so can you give us some examples of things that you do?
Absolutely. What we're going to do is look at your building's purchase price, right? And so you subtract out the land from that, and then the remaining is building. So we're going to break that down into a faster depreciating asset. So typically a commercial building is rated at 39 years of economic life.
Right.
But there's so much of your building that's not going to last 39 years. So why would you depreciate it longer than its life? So we're going to break it down into either like a 5-year category, 7-year category, 15-year category, and then the structure itself is 39 years. But those faster depreciating assets, we can start depreciating those right away. Now, the great thing about once you have it broken down like that, you can apply some of the new tax law, especially what's called 100% bonus depreciation, which came back into play last year. So all those things in those faster depreciating buckets, once you do a cost segregation study, you can subtract that as a depreciation expense, 100% of their value right now in the current tax year.
Wow. Okay, now, I mean, this sounds like it's quite the undertaking. Is it? I have so many questions at this point, just so many questions.
Sure.
Like, how much does something like this cost, and how much of a savings is it going to do? I mean, is it worth going through all of this, and how much work is it for the actual owner of the building?
For the owner of the building, it's very little. I mean, we're going to ask for some information like, proof of what you paid for it. Then if you've been depreciating a while, we're going to see the depreciation schedule. And then there's a couple of items just about the cost, that you actually put into it. And then we're going to do the rest of it. So it's not a lot of time other than the upfront, discussion. We're going to give them an estimate. So discuss the estimate, discuss the price. But then we're going to give you an estimate of what we think we can return you as far as depreciation dollars that you haven't been using. Typically, an average, a building can end up getting 25 to 30% or a little bit more of its building value in increased depreciation. Now,
Wow.
that's a one-time adjustment, but the whole
Right.
idea is that, time value of money, what are you going to do with that money that you're not sending to the IRS, right? So the increased depreciation is going to reduce your taxable income, which means it's going to reduce the taxes you end up paying.
Wow. Okay. So what happens if it's getting closer to that time frame where it's ending its depreciation? Is that when you encourage a 1031 exchange, or what do you do at that point?
Yeah, if you're getting ready, I mean, if you've owned the building for more than, let's say, 10 years, there may not be much left that we could accelerate because you've been writing off so much of it, over that time. But if you're getting ready to sell it, we would say let's not do it, let's not accelerate the depreciation. But definitely, if you want to sell it, do a 1031. So even if you've done a study on a property, when you put it in a 1031, everyone is afraid of what's called recapture when you do an accelerated depreciation. Doing a 1031, there is no recapture. Everything gets rolled into the next building. And so that's a great way to take advantage of cost segregation and then not pay taxes because you're rolling it all into the next building.
Okay, so how long would you recommend that they wait after doing this before doing a 1031?
That's a great question. Our average is usually we tell people wait 3 to 5 years. And it really
Okay.
depends on what you're going to do with that savings, those dollars of savings. You're going to invest it into something else, right? Another property or whatever. Depends on what that return is on that invested savings. But typically, we say if you're going to plan on holding it for 3 to 5 years, this makes financial sense.
Okay, so let's say they own the property for 3 years. That's really a good time to go ahead and do this. Or do you recommend right from the start?
I recommend it right from the start because it's all about the time value of money. So if you can reduce the amount of taxes you're paying today versus in 3 to 5 years, you're going to do something else with that money. But the great thing is if you haven't done it and you're going to own the property for a while and you've owned it for a couple of years, you haven't missed the window. We can go in and actually make a retroactive adjustment looking at the amount of depreciation you could have taken through a cost segregation study, less what you've been taking already, versus which it's called straight line. You've been depreciating it for several years. The difference between what you should have taken and what you have taken is what we can record. It's called it's a look back study, and we're going to do a single entry in the current tax year on what the difference is between what you should have taken and what you did take. That's a great way to think about this because you can make that adjustment without amending previous year's returns, which is what people, once they've owned it for a couple of years, they said, "No, I don't want to amend the return." You don't have to because what you're doing is just changing your accounting method of depreciation. And so the IRS says rather they don't want a bunch of amended returns either. So they'll let you make all of that adjustment in the current tax year.
Wow, that's fantastic. All right, so that's a commercial building. It's 39 years, but there's a lot of investors out there that are doing residential properties as investment properties.
Yep.
And those are, excuse my memory, I think 27 years.
27 and a half. Yes.
Thank you. All right. So what about those? Is this something that you can do on those as well, or are they just kind of out of luck?
No, absolutely. Now, the one thing we will tell people is that kind of the sweet spot for an investment to look at something like this is about $200,000 in building value, right? So you take the total purchase price of the property, subtract out the land, and if the difference is $200,000, then it makes sense to do this. Commercial buildings that non-residential, like office buildings and those things, are going to be a bigger price point. But even if someone has a building value of like $300,000 on either a vacation home or just a long-term rental, it makes sense. The
Okay.
difference on residentials is how are you operating the property? Is it short term or is it long term? There's other things that kind of affect that, whether it's active or passive income. So that gets into the weeds real quick, but it's still something you should consider, especially if you have a portfolio of properties.
Right, right. All right. So, for example, just for kicks and giggles, I'm just trying to understand. Let's say you bought a property back when, real estate was kind of low, and let's say you bought it for, I don't know, $60,000. And then, of course, COVID happened and Florida went up astronomically. At least our area did. So you've gotten a lot more value to the property. Um, the land, let's say, is worth we'll say 20,000. Just for kicks and giggles and leaving it all really, really nice numbers. So the house is now worth 230. In
Yeah.
that, is it still too low to mess with? Right,
A couple
borderline.
things on that. It's when you bought the property that sets the price, right? So if you bought it several years ago at 60,000, that's your basis, that's your cost basis. Don't look at what the market has. It depends on what you bought it at, and that's what we have to look at. So if 60,000 minus, with 20,000 for land, that's going to be way low. So we want to look at when you bought the property, what was the value of the building at that time, not
Okay,
what the
so
current market value is.
that is fantastic. Thank you for helping me understand it. So it's
Sure.
more for those that are buying the property at 200, 250, and those are the ones that really need to take a look at this.
Absolutely. Absolutely.
Okay, gotcha. So 250. Well, here in Ocala, we have pretty much um, any number, like thousands of houses available that are brand new construction, 3 bedroom, 2 bath, double car garage on a quarter-acre lot, and they're going for about 230 to 250.
Right.
So that's a really good price point for investors, of course. And, they're getting really good rent on those as well. So, to have an ability to get a tax write-off as well. So what
Yeah.
kind of thing would they be looking at with something like that?
I'm sorry. Would you ask? Was the
Well,
fee?
yeah. I mean, what would be the fee and what can they expect as far as, a tax depreciation on that? Because I mean,
Yeah.
that's
Yeah. Yeah, the fee's gonna in that range, that price range, the fee's probably gonna be around $3,000 to $4,000, right? Typically, the return on a residential building of that size is gonna be probably about 20%, 25%. It's a little bit
wow.
lower than a commercial building, but still it's relevant, right? So it's one of those things where if you can get a $30,000 tax deduction on your property, that's significant, especially if you have a portfolio. And that's one thing to realize is that if you've got a portfolio of rent houses, you can do a study on one house, and that savings offsets all of your rental income, not just the income from that one house.
Wow.
So for people that have portfolios, these are great. I mean, you may have a collection of, 5 or 10 houses. Doesn't mean you have to do 5 or 10 studies all at one time. You could spread them out and do a study a year, and that's going to give you a pretty significant reduction to your income from all of the houses because all the passive income, gets put into your passive income bucket, if you will. Um,
That's fantastic.
the other thing to think about if someone this is their job and this is what they do is real estate, buying and selling the real estate that they own, they can qualify for what's called the real estate professional. It's a tax status. Then that means that all of that income is no longer passive because they're working in the real estate activity. You have to get that certified by your CPA, and you have to be able to prove that you're working at least 750 hours out of a work year on real estate activities for those properties. But then that all becomes active, right? And so that way, all of your other income in the real estate arena, if you will, showing properties, whatever you're getting income from, the cost segregation can offset all that income, not just the income from the rent.
Okay, unfortunately you lost me. So
Yeah.
I'm I'm like, you want to do what? So what would be what would be the benefit to doing that?
Well, if you had other income sources, let's say this was all you did was real estate, right? And I'm not saying that you're like on salary for a realty company, but you're doing your own thing. You own some
Sure.
properties. There's maybe you're doing some property management on the side, doing other real estate activities other than working on the properties that you own.
Okay.
So all of those income streams are what's called your active income. Rent
Right.
is another active income. If you let's say you're a doctor and had some rental properties, well, your main income is your practice. So in that case, all the rent income is passive for you.
Right.
Then the cost segregation would just offset the passive income, not all of your income.
I see.
Right. But if you get that real estate professional status, and the weird, it's kind of a misnomer. You don't have to be a licensed realtor to have a real estate professional tax status. It just means that all of your time is spent dealing in real estate. It could be the real estate that you own or managing other things, but that's a little bit of a different designation, and you better have some documentation behind that to prove it. But I mean, like I'm talking like time logs, right? If the
Right.
IRS asks you about that, you need to prove that you're working 750 hours
Right.
because there's only a little over 2,000 hours in a work year, right? So if you've got a W-2 job, chances are you're not going to have 750 hours, spare hours to be able to work in the real estate. So you really have to be full-time in real estate activities to be able to, to quantify this. But the great thing is once you have it, it's a great, it makes cost segregation that much more powerful because it can offset all of your income, not just the rent income you receive.
Wow, that's fantastic. I mean, I'm getting all of these gems from you today, Tom. I'm all these gems. So, what else would you recommend for people to do, or if they're maybe new to investing, they've only got, a few properties, one or two
Yeah.
properties, and they're just trying to figure it out. Like, what are your recommendations for them to get started and to really understand what they're doing and best plans?
Well, I guess the first thing is to get an estimate. We provide no cost estimates on properties, right? So if they have a question and want to look at them, they can contact me. My information is behind me. My telephone number and the email address is on the screen behind me. Either message me or send me an email, and we can start doing a no cost, no fee estimate. And then if you want to go forward, then we'll tell you what the fee is going to be and what we think we can do for you. Also, if we think there's not going to be enough value, we're not going to encourage you to do it. We say, okay, the one thing don't want to do is charge you $3,000 in the fee and you're saving $4,000. That's not real. That's not meaningful, right? So I would tell you probably don't want to do that. And then we can give you some other strategic things, a way of looking at your properties. The other thing I would tell people to do is if they own properties, look at your depreciation schedule. This is the biggest thing I found in the past year that is just, it blows my mind. What happens is that you have a differential between the building value and the land value on a depreciation schedule. A lot of people have never seen their schedule because it's something that the CPA holds. But if you have more allocated to land, you can't depreciate land. And so that's never going to be something that you can claim as depreciation expense. I found one property, this was a vacation home property in Colorado. The land was overvalued by $800,000.
Good grief.
Owner had never seen it. Because he owned it for a couple of years, I said, show me the schedule because I had run into this problem so often that that's the first thing I check. And so he didn't know how that got there. He'd gone to a new CPA. Nobody knew where that came from. So we fixed it. We were doing a cost segment on the property anyway. So that additional money that should have been in building, we got it changed. The allocation between land and building changed. And so that value went into the building. And then that's what we could look at doing the cost seg on that new value. That's called a change of accounting method form. And we can provide that too, because that's a bear of a form in itself. And no CPA I've ever talked to ever wants to do that form. It's not something they do often. It's a 25-page form. It takes a lot of time
Good
to do it.
grief.
We do this all the time, and so we've got it set up. So it's pretty much, something we do in our sleep almost, just because we do them so often. But
Right.
that's the one thing. Just make sure that your building value and land value is in line with the true value of land, because if you've overvalued land, you're never going to get that costs back as far as the depreciation expense. And
Wow.
and people will be amazed when they see that. In fact, I ran over one today, didn't have any land value on it. And that's something that's kind of a standard CPA form. And they'll ask you for land value. What you don't want is to have them make it up because they,
Yeah.
there are sources you can go to get what the county says, but sometimes that doesn't get followed. And it's just, as the owner of the property, you need to know that that land value has been recorded correctly.
Right. No, I can definitely see that. Yeah, there's a lot of people just go by what's online and the tax assessments and stuff like that, and then they come and tell me, "Oh, well, my house is worth this." I'm like, "No, no, no, no. That's for tax purposes only. That's not that has nothing to do with anything."
Yeah, yeah.
So, yeah,
And a lot of times you're right. I mean, the county may get those wrong, but
yeah,
sometimes the county gets it wrong the other way, right? So they overvalue the
right,
building and the land is pretty close to market or maybe a little bit below. Then
right.
you could use that, you could use that as a third party confirmation. So it
Yeah,
just
the
depends.
normally I would say the land is pretty close, pretty accurate.
Yeah,
Um, the actual building itself, not so much. Not so much.
absolutely. Absolutely.
Sometimes they'll add a bedroom, sometimes they'll take a bathroom away. It's just kind of, yeah, you just don't go by that necessarily. Yeah. Some information is great, but I would say trust but verify.
And that's all I'm saying is that, the one thing that people need to do is look at it, right?
Yeah,
And make sure you're comfortable with the way it's set up. Don't make the mistake of, oh, my CPA's got that handled. It's not their expertise. You
yeah,
should, as the owner, it's really in your best interest to make sure you're comfortable with that.
right, right. All right. Well, is there anything else that you could tell people that they could or should do as they're getting into the investing lifestyle?
Well, it just depends if you, like I said, this is not cost segregation is not for flippers, right? So if you're going to buy a property, fix it up, and then sell it right away, you don't want to do cost segregation because you're going to have to, when you accelerate the depreciation and you sell it, like shorter than the 3 to 5 year window we talked about, then that's you're going to have to give a lot of that savings back. So this is for people who are going to own property for about 3 to 5 years, and then this is something you want to do to maximize your investment, right? To be able to lower the taxes you're paying on that. So
Yeah.
that's the
So
key thing. But this is not for flippers.
right. Thank you for pointing that out. Yeah, that's what we call buy and hold. So you buy them and then you hold on to them.
Absolutely. Yeah.
So, yeah. So flippers are fantastic and it's a lot of fun, but it's also nixes you tax wise on a lot of things. So, it's a little different. It's a little different. So there's a lot of people that love to flip though. Good grief. They love finding that diamond in the rough and cleaning it up and selling it. So, more power to them. But for tax purposes, it can get pricey pretty quickly.
Absolutely. But I mean, the people that are buying properties, if they're buying a flipped home and going to make it an Airbnb versus a long-term rent house, that's another decision to look at because the classifying the rent income you get from an Airbnb, it's got a lot lower hurdle than a rent house like you're gonna rent for a year or 6 months or a year. It's short-term rental. And so as long as the owner is performing more of the activities of managing that short-term rental, the vacation home, than any other entity, then that's active income for them. And so a cost seg on that type of property could offset all of their household income, right?
Wow.
So not just the rent income they get from that one Airbnb property, but their main job, if they have a job, or and their husband, if the two spouses are filing a joint tax return and one spouse has a really high paying job, the cost segregation savings can help offset all of that tax liability.
Wow. This is really when it gets more into buy and holds can be a fantastic tax shelter. I mean,
Absolutely. Yeah.
really, and completely, totally legally too.
Oh, absolutely. Yeah. It's all there to help benefit, the owner of the property. And this is where a lot of people that I run into, I say, "Have you own any commercial property?" And they go, "No, I just have a rent house," or "No, I just have a vacation home." It's like, somebody's paying your rent for that? And they go, "Yes." I said, "That's a commercial property as far as taxes go. And so let's help you minimize that."
Yeah. Excellent. Excellent. Okay. So what is your favorite part of the job? Because I can tell you right now, just that 25-page document alone has me going, nope, that does not sound like fun. That does not sound like fun. So, I mean, what do you enjoy about it?
I really enjoy just, I call myself the found money guy too, because this is something, it's found money. And even if you stick your hand in an old jacket that you haven't worn for a while and you pull out like, a $5 bill, that makes your day, right? Just that little bit of
Sure.
found
Yeah.
money. This is what I do, but several hundred thousand times more is discovering ways to unlock money that people didn't know they had. Like the one instance I talked about, when the land was overvalued by $800,000, so we put that money back into that owner's pocket more than he even thought. So that was truly found money for him because he had no idea. And so when I looked at the depreciation schedule, I said, this is your business, but why do you have this valued so high? And then I told him what we could do, and he went, "Oh my God, that's just great. Thank you." But he'd never seen it. He'd never seen the schedule.
Wow.
So
Wow.
that's the biggest thing is when I can over deliver based on something that somebody else did. We're going to fix that. And he hasn't lost the ability to get it fixed and still get the benefit. Those things
Wow.
like that are probably what I enjoy the most.
Really? So how did you get into this?
It's kind of strange. I was looking for something to do. I'd worked for Shell Oil for 27 years and was looking for something else. And a friend of mine told me about this cost segregation, and I looked into it. And initially it's such a no-brainer. I thought everybody's going to be doing this. There's going to
No.
be there's going to be nobody left, that I could sell this to. And
Yeah.
then when I looked into the reality, it's like, no, there's a lot of people who have never heard of this before.
I
And
I can tell you I've never heard of it before until you reached out. I was like, "Wait, you're doing what?" So yeah,
Yeah.
no, there's not that many people out there doing this. That's for sure.
Exactly. And even commercial realtors, the ones that just buy and sell like big office buildings and things like that, they're not that aware of it either. And so I've been reaching out to when I see big listings for a big property, I'll reach out to them and say, hey, this is because they could use it. I mean, I know they're selling the property, right? But they could talk to their prospective buyer and say, hey, have you heard about cost seg? We can knock a million two off of your purchase price here when you do this. So it's things like that, just trying to go through an education process to let people know this is out there, it's absolutely legal, and you need to look at it. If it makes sense for your situation, why wouldn't you do this?
Oh yeah, no. I think there's a lot of things tax wise. You're right. As soon as people say IRS, they get nervous. But there are a lot of things that you can do completely and totally legally that a lot of people are unaware of. I was actually really surprised by how few investors know about 1031 exchanges.
Yeah.
That was truly shocking to me because I figured anybody that's investing would know how to do that or would know to do that. And no, that is not the case at all.
Well, same with cost segregation. I mean, when I first started, I've been doing this about 8 years now, and when my first clients owned a lot of storage facilities, right? Self-storage. He was building, I mean, as soon as he built one, it filled up. And so he had to go find another one and build it. He'd owned those type properties for about 20 years, never heard of this. And I got introduced to him through a mutual acquaintance, and he said, "Oh my God, this is awesome." And I've done about 7 properties for him now. And we did the first one. He said, "Why isn't everybody doing this?" I go, I can't answer that. They just don't know. I mean, this is something that CPAs themselves don't do, and so they don't talk about it. But there's a lot of people like me out there that can provide this service. You just have to go find them.
Yeah,
And it's one of the reasons I wanted to come on your podcast is say, let's get the word out so people know.
yeah, that's fantastic. For everybody that's listening in, his phone number is 713-906-3710. So, or you can do tom.brodie, it's Brodie at cssiservices.com. So we will have all that information, of course, on our YouTube channel, but not everybody gets the visual. They just sometimes just get the the verbal. So we want to make
Absolutely.
sure that they can reach out and they can find you, and hopefully this will help quite a few people. I would love to hear from anybody that does use his services and is like, yeah, I just saved $30,000. So, I mean, that would be epic. I would love to hear that.
Yeah, I mean those things they're real. They may not want to tell you how much they saved on their taxes, but I mean they can say, "Yeah, I saved a
Fair
lot of
enough.
money," right?
Fair
So
enough. Fair
that's one
enough.
thing I've found when I was trying to get people to give me reviews. They didn't want they didn't want to put it out there. They saved a lot of money on taxes, which is I can understand that, but it's one of those things. And just
Time.
to let people know, the 713 area code is in the Houston, Texas area, but I can work in any state across the country. So a lot of this is done virtual, and we will send photographers out to take pictures of your property. But then all the information on your property, we're going to get that from you. And so a lot of the stuff is done remote once the pictures are taken.
Gotcha. All right. Well, that's fantastic. Thank you, Tom. Is there anything else that you want people to know about or
Just
say to everybody here?
I would say don't be afraid to ask questions, right? So if your tax expert is your CPA, ask questions. If he doesn't know, find out or ask him to go find out, or maybe you find out and just see if this is something that's worthwhile. Like I said, we give free estimates. So take the estimate and then go to talk to your CPA about it. And the reason we give free estimates is like once the CPA sees it, or once the CPA knows that we're going to defend our work and they don't have to, then they usually say, yes, this is something you should do, right? But that's the one thing to just investigate and just see how else you could save money on your income taxes.
Awesome. Thank you so much, Tom. Thank you so much for joining me in the podcast today and the YouTube channel and the radio show and getting out this out there to as many people as possible. I truly appreciate it. I really appreciate you taking the time.
Not a problem. Appreciate you having me on.
Thanks for spending part of your day with us on What's Up Ocala. If you enjoyed today's show, be sure to share it with a friend, subscribe wherever you listen, and follow us on social media so you never miss an episode. Until next time, I'm Andrea Praber reminding you to shop local, support local, and stay connected, because there's always something happening in Ocala. We'll see you next time.